All right, so we're going to do a turning point review of how many turning points there were, minor turning points, meaning within the range of the daily chart. How many turning points were there? How did they occur? So on and so forth, using the 5 minutes. So this is basically daily in 5 minutes. First thing you want to see is the daily. And what do you see the daily? You see, very clearly there's a breakout right there. And the market rallies, right? So as it rallies, the first turning point we're going to take a look at is right there. So this is, the end of the rally and the start of the pullback. Okay, so this is the first turning point I'm going to take a look at. And then we'll take a look at some other turning points, because there's a number of turning points / pivots, and you want to see what happens on those pivots. So basically, pivot is nothing more than supply overtaking demand, causing the down pivot, and then demand overtaking supply, causing the up pivot. But to be able to see how that occurs is a very critical skill, and it is one of the key skills in Wyckoff. All right, Wyckoff was all about catching the turning points, and that's actually why he focused so much on the climax, because climax is ending action, and ending action means that the left-hand side of the pivot is done, and the right-hand side of the pivot is going to be, your change of behavior, and then your low volume pullback, LPS, LPSY, etc. And that's what sets up the trade. So anyway, so I'll just go over it and show how it's done. All right, so we see on the daily, you have a rally, and where I have the circle marked on the daily, that's where there's a turning point, meaning there's a pivot. So let's take a look at how that occurs using the 5-minute chart. So you have a daily and a 5-minute chart to go inside the daily and identify the turning point. All right, so we see the daily rally. It goes up here. What is one of the things you see is this lack of demand, but I will be very frank with you, lack of demand doesn't mean anything, or neither does lack of supply mean anything. It is totally meaningless unless there's a change of behavior. All right, lack of demand and lack of supply are useless unless there is a change of behavior, because you could have a lack of demand and it pulls back a little, and then demand comes in and it'll just take out the high. So you have to understand what's going on. All right, and what makes one signal work is the other signal. Anyway, so you have these series of highs. Now what's going on here? All right, this is really important. This happens a lot. This is the initial distribution right here. After this distribution, there's a drive up in order to go down. I guess you could call it an upthrust. I don't know what to call it other than an upthrust or a drive up in order to go down. But a lot of times you see this, this move up in order to initiate the selling down. It's like trying to go one way and then going the other way, but with a lot of force. All right, so this right here is the initial distribution. At least in my eyes, this is what I see as the distributive action, and it's very clear because it holds, and I'll show that. All right, so this is a distribution, goes up, and bang, verifies your distribution. What's really nice about this is that you have the fake out, or the what the hell is it called? Anyway, it's like you see this a lot. All right, you see the sideways chop, which is actually distribution, and then it takes out one side and then it takes out the other side. So this happens a lot. I'm not sure if there's ways to identify this mechanically, programmatically, but you will see all the time. I mean, I've even seen this on Renko, that this is how these things change. There's like some sideways action, then it goes one way, fake out, and then it goes the other way with a lot of pressure. And this over here is the biggest price wave in 23 waves and the biggest volume in over 49 waves. So I know the market is done. On the upside is they're not gonna recover from this. All right, it's just not gonna happen. Sorry, it's not gonna happen. So it's a very easy trade because you have this distributive action. It goes up, fails to go higher, and sells off on a lot of price volume. So, I mean, it's going to work. Okay, now, where in this area was the most amount of distribution? If this was a figure chart, which line of distribution would you use to do a count? That's the same line of distribution that would have the most volume. So one way to do this, I mean, there's multiple ways to do it. One way to do it is just use the profile. But you could also use a Renko chart. You could use whatever approach you want. The key is when you draw it, you gotta extend it back. You wanna play with it and bring it back because you want to identify that level where this level is not just a point of control or some value area or whatever this, some distribution, just some bell curve. What it is doing is identifying distribution and the line of maximum distribution. That is what folks are calling point of control. And that's what it's called. But from a Wyckoff perspective, that line of distribution, that is where the most distribution took, is very important because it won't be able to get past it. It will not be able to get past it. They will defend it because they spent all that money there selling. That's the position of the composite man. So after it goes down, pap, you can't get above. Sell, pap, again, pap, again, pap. You see, resistance. You can't get above it. It's being defended. All right. So now that you see all that, the other really, really important thing is you must have weakness, because what creates direction is strength on one side plus weakness on the other side. So you need strength in supply plus weakness in demand together. And when that situation occurs, you will have direction. Let me say it again. You must have a lot of supply with very little demand in order to create downtrend. And vice versa. You must have a lot of demand with very little supply in order to create an uptrend. That situation together creates trend. That's how trends are born. They are born with strength plus weakness. One side extremely strong and the other side extremely weak will create that trend bias. So I've shown you the strength. Now the next question is, where is the weakness? This is the strength in supply. Where is the weakness in demand? The answer to that question is, first of all, how do you judge the weakness in demand? So the three factors that are always used with wave charts to judge strength and weakness of supply and demand are very simple. They're price, time, and volume. So I'm just going to use the volume approach here, but I could easily use price and time. Price and time can be used. Time by itself can also be used. Price by itself can be used. And volume by itself can be used as well. So the question is, from the volume perspective, where is the weakness? All right, now you can do it based on price, you can do it based on time, but I'm going to show how it's done from volume. Now we know over here it's 139, right? Usually, if the volume on demand volume goes to, say, about 1/4 of this amount, in my opinion, that would be weak. 25%. All right. Now, where do you see 25% of this volume? Right there. It's actually less than 25% of this volume. And look what happens. The puke fest. So this is the extreme demand. This is the extreme weakness. Excuse me. This is the strength in supply, and this is the weakness in demand, and this is the result. Trend direction. Now, how Wyckoff described this is he called it the feather's weight. All right. It is also known as your LPSY. I think it's LPS or LPSY. This one is whatever. But I mean, the very clear example would be your lack of demand. Whatever you want to call it. You want to call it feather's weight, like Wyckoff did, LPSY, like SMI did, or the common sense, which is lack of demand, because there's no demand. This here is the smallest amount of volume in at least 10 waves. 20 is less than 47, 146, 74, 57, 75, 25, all the way up to here. So 1, 2, 3, 4, 5, 6, about 7. About 7. All right, so you see how low that volume is, relatively speaking, when compared to the volume on the other up waves. There's your weakness. So you have the strength in supply, and you have the weakness in demand, and you have direction. This is how turning points occur. Now I'm going to show, okay, so this is what created the turning point, and it went down over here. Now, this right here is the next. So we went over the first turning point. We're going to go over the second turning point. Now, what do you notice right there? Demand is coming in. Y climaxed right here. So you have climactic action on the 190. Then you have buying pressure here. Okay. Now, again, using that 25% rule, I made this rule up from my experience. I know that it works. So, I mean, you have 81 here. Look at this. 17 fits the bill, and so does the 5, right? So you have that strength, and now you have that weakness. The direction is created. But they're very slick, knowing that as price goes up, there are times when there's going to be a shakeout. There are times when there's going to be a drive down to test everything before going back up. Okay, so this is a matter of placing the stops. So at this point here, your market right now, oh yeah, I forgot to mention, when that point of that weakness is one other word. springboard. This right here, when you have that strength plus that weakness, is also known as your springboard. Okay, and why is it called a springboard? It's called a springboard because it propels you into one of two phases, one being markup, the other being markdown. In the case up here, from this point, we are no longer in distribution. We are in markdown. In fact, specifically, that bar right there, that is the markdown bar. That bar is the markdown bar, which means you're no longer in distribution. There's nothing more to sell because the volume has gone so low, and now you can initiate markdown. Why? All the selling is done. Markdown. Specifically, I mean, same thing over here. All right, now over here you don't see the markup bar, you see a wave. Sometimes you get a wave, but it's actually, you know, they do a drive and then you have the markup bar right there. What does that mean? That means you're in markup. What does that mean? That means accumulation is done. How do you know? Low volume. Where's the low volume? Right there. Where's your springboard? Right there and right there. Okay, there's actually two of them. This is the springboard and this is springboard. What's the difference between the two is that as soon as this tried to attempt, the sellers sold resistance and they drove it down until they couldn't drive it down anymore because there's no volume. So then it reattempted to mark up right here. The first attempt to mark up was stuffed. This was the first attempt to mark up. This was the first attempt to leave the accumulation and go into markup. But as you can see, it failed at resistance. So they took it right back to the supporting area. And then again, the volume dissipated. It went from 35 to 20 to 10. What do you see? Volume is gone. Selling pressure is gone. What are they going to do again? Attempt to remark up. There's your markup bar. What does it do? Bang. Creates this movement. Where does the movement go? It goes to a resistance area. Where's the resistance area? Against the markdown bar. Where's the markdown bar? Right there. That's where it goes. Tap. Then it goes down here. I mean, I can't explain this behavior. It's some type of crazy, you know, spring and then goes back up. This like erratic behavior. So I can't really, you know, I'm not going to try to explain every behavior. You just need to know that there is selling pressure initiated from the markdown bar, and that is the logical target because it's untested, that area untested. So you get the hell out when it goes there. Okay, and also you should also know that this selling pressure was the result of testing that breakdown markdown bar. This is where the strong sellers are. That markdown bar initiated markdown. Obviously, if you test it, what's going to happen? It's going to go down. That's where they are. That's where they were, and that's where they still are. And that's what, you know, if you want to know what the reason is, I mean, take a look at the size of this bar. Take a look at the weakness from it. Take a look at the result. The intraday downtrend resulted from this. So obviously, if it goes back there, that's where the CM is, and that's why it went down. And the rest of this, I don't know what the hell's going on with this crazy behavior. So I'm not going to try to explain it. All I'm going to say is it does a whole lot of shit that I can't really explain. So now we wait, and then we start looking at it, and now you see 22, 40, blah 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 blah, right there. Something's going on right there. How do you know volume picks up? And folks, the signature of when this happens is that, you know, that climax automatic rally. I'm going to say it again, the climax automatic rally. The automatic rally, and you're not going to hear other folks say this, or at least I haven't, but that automatic rally, the key word being rally, is your change of behavior. That is the change of behavior that happens after the climax. When you have a climax, look for a change of behavior right afterwards. That is one, for lack of a better word, pattern that a change of behavior typically presents itself, coming right after the climax. The second way is after shortening of the thrust, meaning there's a lot of lack of supply or lack of demand. You have a lot of shortening of the thrust, and the market is just so pathetic that it cannot go any further. It has those, you know, grinding like behavior, and creates a shortening of the thrust, and then you have a change of behavior. So those are the two most common ways a change of behavior occurs. For me, I know that this is the change of behavior. How do I know? Because look at this, 175, big red right here, big red. So big red. So this change of behavior came from the climax, which is the first quote-unquote pattern or first schematic, which says climax, automatic rally, secondary test. This is the climax. After that, the automatic rally, which is your change of behavior. Bingo, right there. All right. Now, whenever you're looking at this, you must have a level. If you don't have a level on a higher time frame, then it's the levels equal context. Again, I'm going to say that levels equal context. You have to have context so you see where it's occurring, why it's occurring. You kind of have to know that. That will reduce the randomness. Otherwise, one of the biggest mistakes with a lot of the traders is they just looking for a change of character or change of behavior randomly on the chart without context, without the higher time frame levels. There has to be context. All right? You want to see places where strong hands were to see if they are currently still there. That is what the level represents. Areas where there was demand emanating from, areas where there was supply emanating from in the past. And then ask yourself, are they still there? If there is a change of behavior, that means they are still there. All right, now, so this thing over here, I know, you know this level, right? I mean, obviously, if you look at the daily, it's very easy to identify that this is at that level, and now it all makes sense. All right, so hit the climax, hit the automatic rally, which is your change of behavior, and then you have this selling pressure down, you know, and goes down and down, down. And what is one giveaway? One giveaway that there's accumulation is when you have the sideways waves. Is it downtrending anymore, or is it moving sideways? Oh, it's moving sideways, building volume. Here, where you have this heavy print, it's actually coming from this sideways block. There's a block right there. See that block? They try to go down, buy. All right. Have a little spring, you know, and then it does this. Okay. Now, I see the 79 in the background. This actually is the lack of supply on another wave scale, so don't worry about that. But here I know that something's going on. Now, I've said it again and again. Direction. What is direction? I'm giving you the fucking formula for direction. It is extreme strength plus extreme weakness creates direction. There's your strength, which is the biggest volume, not biggest volume, but the biggest price move in the last 6 waves. And in the background, you also have big volume, right? You see the volume here is bigger than 1, 2, 3. I mean, it's not that much, but I know that, you know, there's pressure. So you have volume here, and you have the biggest price move in the last 6 waves, showing there is strength, especially when it takes out this high. Now, the second part of the formula is weakness. 1 to see weakness. Now, typically, I gave you one way to identify weakness, which is when the volume is less than 25% of the change of behavior. All right, that is just my own thing, that I believe that's the case. When it's 1/4 the volume of the change of behavior, it is a lack of supply, a lack of demand. When the pullback, the low volume pullback, is 1/4 the volume of the change of behavior or less, it is a lack of supply or lack of demand or feather's weight, or what's the other one? LPS, LPSY, whatever. Now I'm going to give you the second way to do it. The second way to do it is to take a look at how small the volume is relative to the other down waves. Meaning it is the smallest down wave in how many waves. Again, the second way to identify weakness is to identify the count of how low the volume wave is relative to the prior volume waves. So very easy. 35, is it less than 56? Yes. So it's less than 1 wave. Is it less than 58? Yes. It's less than 2 waves. Is it less than 45? Yes. Less than 3 waves. Is it less than 120 and 175 and blah, 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 blah? Yes. In fact, this 35 is less than the prior, I think, 8 waves. Okay? Now, if it's less than the prior, say about 4 waves, it's weak. All right? So the first way to identify a weakness is the 25% rule, which is arbitrary and I made it up. The second one is also arbitrary and I made it up, is that it's the lowest volume in at least 4 waves. In this case, it's the lowest volume in 8 waves. So this would represent weakness. You have strength, strength, weakness. Strength plus weakness equals direction. And here you have the market, which is now on the springboard. Now look what happens. All right. And after it does all this shit, so I don't know, this is the second or third turning point. Now we'll look for the next turning point, and using the same thing that I'm just teaching you. Over here, you have all this shit, and I actually had an indication. I don't know what happened to it, but here, this is the biggest down wave in 33 waves. So even if you get lost in the chop, you just keep wait, bang, right there. Biggest down wave in 33 waves. The volume is not that much because I'm not including overnight data. I'm just including day session. If I was to include overnight data, it would be much more. Because I don't want to include overnight data. I mean, there are times I do it, but it's just so much chop that I just don't want to see it. All right? But in terms of the length, it's the biggest down wave in 33 waves. So automatically I know that this is a change of behavior. I can't catch them all programmatically. So I use stats on, just figure out what the hell is going on. When I see numbers like this, I know that this is clearly selling. Clearly selling. Here, there was also selling here. Right? So you could say this one. And then right there. that 5. That's also weakness, right? Then look what happened. It fell, it retested, and fell some more. It did not get above this high. So you could make the case that this is the point where direction is created, right? You could also make the case here, because it does the same thing. Meaning you have this selling pressure, bang, and now I'm looking for weakness. Where is the weakness? Right there. Here and here. How do I know? That's the smallest in more than 49 waves. That volume is the smallest in 49 waves. Where is the markdown bar? Okay, this is a little subjective, but this is actually one here. All right, and then I'm going to look for the break. I think this one would be right. I think it's this. Those two bars. It's one of them, maybe both, but those points would represent markdown, which means the market is no longer in distribution. It has entered markdown. How do you know that the market has gone from a phase of distribution to the markdown phase? Is because of the markdown bar. Same thing with accumulation and markup. How do you know? You know because there's a markup bar. How do you know it's the markdown bar or the markup bar? Because before it, you have something called a springboard. What does the springboard do? It basically moves you from one phase to the other. It springboards you from accumulation to markup and from distribution to markdown. And there you go. It's either this one or this one. Both of them are valid. Also note, because after the markup or markdown bar, you're in markup or markdown, but you can always have a test, like what is it called? A shakeout or a full test, and then it goes. That's the situation here. All right. So now all of this shit happens. Now we are back in play. That's a lot of volume. So from the 3 examples I've just showed you, what do you think I'm going to do? And what do you think I'm going to look at? And what do you think I'm expecting? It's the same thing I've just shown. All right, that's enough. And this, folks, is real Wyckoff. It's not the shit that you see on the internet, which I have no idea what they're thinking. But if you want to see more of this, read the original Wyckoff course. You'll find this in his writings on the wave chart. All right. So in his writings on the wave chart, he very clearly explains this. The only thing is, he explains it from the perspective of time and price. All right. So time and price. All right. But I mean, he just replaced that with volume and. Let me think. I don't remember whether he did it from. I know he did it from volume and activity. So he basically has studies where he has from the time and price perspective, which is very easy. It's excellent. It's very easy. And then after that, he has it from a perspective of volume and activity. The problem is we can't really use activity because it was a proprietary way he calculated it, but it was highly correlated to volume, so you can just use volume. So just use, volume, or you can use time and price. And I put some videos on how to use time and price. Why that's important is that, first of all, I think that time and price instead of volume, it allows you to look at many charts and not get confused by volume. Why? Because the time, if you see a down wave that's only 5 minutes, obviously it's weak on a 5-minute chart. It's only one bar. The wave is only one bar, it's going to be weak. For example, this one here, it's like 1 or 2 bars, 1 or 2 bars. So it's only 10 minutes, so this is weak. Right? And it's very easy to use that for multiple charts and not get confused by the numbers and volume. So time makes identifying weakness very, very easy. The other thing is, for Forex, if you're a Forex trader and you don't have volume, what do you use? Use time and price. So it can easily be applied on the Forex chart, on Forex markets. Anyway, good luck to you whoever's learning Wyckoff, and have a good night and weekend.